Hi, I'm Jonathan Bays, and this is our February investment market update. We've seen a pretty sizable increase in volatility in global investment markets in the past couple of weeks, and so perhaps this is a timely opportunity for me to give clients a bit of an understanding for why that came to pass, how we think markets will trade in the coming couple of weeks.
It's been a very strong run in the S&P 500 for around about the last 10 years. Historically, when we see a period of really low interest rates and a point in time where markets are considering an interest rate increase, we generally see volatility occurring in markets.
And certainly a bit of a surprise, the sell-off in US share markets in the first week of February. I mean, markets came off over 10%, the Australian share market came down 5 or 6%. We saw a quite significant sell-off in commodity prices, and it was all triggered by a sell-off, in fact, in the bond market to start with. We've talked at length about how we were coming to the end of a 10-year bull run for bonds. Global central banks starting to remove liquidity, and how that was likely to create bouts of volatility in other investment markets, and we saw the first evidence of it in early February. I don't think this is the big one that we should all be panicking about, but I do think it's the first shot across the bow to warn us that we are coming to the end of this 10-year bull run.
It is difficult at the moment to determine whether this is a longer term trend, given the fact that we've had such a strong run in markets. We are very watchful at the moment and looking at the stocks and assets we have in the portfolio to try and understand what this may actually mean. We are of the view that being in index funds needs to be considered at the moment, and moving more towards assets that will take selective strategies within the market. That review is underway, and watch this space over the next 4 to 6 weeks for some new portfolio recommendations.
Bond yields have moved up to 2.85% or thereabouts in the US, and that indeed flows through to the valuation for other asset classes. Again, equity valuations are reasonably high on a historic view, and so as bond yields push higher, it does make equities a little bit less attractive, even in spite of the strong economic growth that we're seeing globally at the moment. Our portfolios are reasonably balanced at the moment. We've got really good exposure, we think, to an improving Australian economy. We put Downer and APN Outdoor in there, and we've obviously had great success with Seek in recent months. But we also have defensive names in there as well, like Amcor and Healthscope, and we'd be looking to add a few more names if the volatility continued. So I think certainly the weakness we saw in early February is a cause for concern. I don't think it's the start of a bear market just yet, but I think as we start moving closer towards the middle part of the year, we'll start to move portfolios a little bit more defensively. One big thing that we've tried to do in recent months, and we will continue to do so, is to reduce portfolio exposure to index. And by that I mean just ETFs, exposure to asset classes such as US shares and European shares. We think it's more prudent to be putting client money into more balanced or discretionary fund managers who we think will perform better if share markets start to weaken off. So the likes of Magellan, Antipodes particularly, Platinum, and also potentially a new IPO coming down the pipe in the coming couple of months called L1 Capital, which we'll talk to you about soon.
Anytime there's volatility in markets is an opportunity for us to review the strategy, also give consideration to buying some assets we believe are attractively priced. Any period of volatility actually presents a longer term opportunity, subject to there being no major issues in economic markets. We do see that there's very positive economic data still coming out of the US, which is why we're actually seeing the increase in interest rates.